Markets have been pretty volatile lately, and so have mortgage rates. Have you ever wondered why they go up and down and what you can do to protect yourself when you're buying a home? Let's talk about bond markets, volatility, and how and when you should lock your interest rate.
Welcome to the Utah Homebuyers Quest podcast with Nelson Bars. Our mission is to give you hope, knowledge, and encouragement on your quest for home ownership.
Housing affordability is at its worst point since 1986.
Higher mortgage rates are impacting Utah's housing market. Potential buyers out there being priced out.
It's getting tougher by the day to afford a home.
Many factors are making it very, very difficult with no relief in sight.
Homeownership may seem like an impossible mountain to climb in today's world. We're here to say that it is possible, and we're here to be your guide, to climb with you, to urge you forward all the way to the closing table. We believe in home ownership, and we believe in you.
Well, hello, everyone. Welcome back to another episode. I'm so glad to be with you, and I commend you once again for being here and learning and taking another step in your quest for home ownership. I really do appreciate the opportunity to work with those who have listened to the podcast. I feel like they come so prepared and have such a better experience when they buy a home. So congratulations to you for being here. Now let's talk about interest rates and what makes them move. When I teach this class to real estate agents, I have a class about rates, basically, and the market movement. I ask them, who sets the rates? And the first answer I usually get is the Fed, which is understandable because the media focuses a lot on every decision of the Federal Reserve. In truth, however, the Fed funds rate is only one of many, many factors that determines interest rates. I would say, in my opinion, the better answer is the bond market, and more specifically, the price movements for mortgage bonds. Mortgages get sold in pools of loans. Hundreds and thousands of similarly underwritten loans get sold on the bond market as a mortgage-backed security. And investors who are buying those bonds determine the price they're willing to pay. And the price of a bond affects the interest rates that they effectively earn as an investor. And so they're pretty conscious about the price they're paying for these bonds based on the market movements today and what it could mean about the future. So specifically, when we talk about what makes bond prices move up and down, it's literally what makes their appetite, these investors' appetite, change, and what their willingness to pay, what makes it change. And I would say every single scrap of news that hits the markets affects the bond market. Over the years, I've come to kind of view the bond market like an emotional child, right? It overreacts to bad news, which drives rates up very fast, and then the investors will slowly absorb good news in a way that makes rates trickle down really slowly over time. There's been very few moments in my career when rates went down fast, but many moments when rates went up fast based on bad news perceived by the bond market. I will tell you, though, it's pretty confusing to try to determine what the bond market would see as good news or bad news. Early in my career, it seemed a lot easier. Good economic news would move money towards stocks and away from bonds, and bad economic news would move money out of the stock market towards bonds. That's where investors tend to go for safety. And whenever money goes into bonds, it drives the price up and the rates down. So it's good for rates, right? Today, however, you have to layer the logic on what exactly the market sees as good and bad news. For example, the Fed might lower rates, but the market already knew that was coming, and they had already factored that into the bond market and the prices. But perhaps the same day, one of the voting Fed governors might say something in the press that indicates that the next Fed move might not be a rate cut. So rates might actually go up that day because the bond market would interpret that as bad news for them, even though technically what the Fed is saying is that the economy is hot, maybe too hot, too strong to keep interest rates low. And you might think that's good news for investors to move money out of bonds and into stock market, but really they see it as bad news because it means less Fed rate cuts in the future, and it can hurt our rates in that very same day that rates were dropped by the Fed. So it gets really complicated, and it's never a given that a Fed dropping the rates would make mortgage rates go down. Now, there are also geopolitical events that move rates. Lately, there's been a lot of strife in the Middle East. So oil prices have gone up, and some expect it to keep going up. And any movement of expectations would make the bond market react. The bond market investors might think that something like higher oil prices is going to lead to higher inflation. So that would mean the Fed is not going to want to lower interest rates in the near future and may actually raise the rates. So as a bond investor, they may hedge their bets a little bit and move some money out of bonds, maybe to cash or something even safer. And then that would drop the price of the bonds, which makes the rates go up. Every day, the bond watchers, the market watchers, are consuming every piece of data available. There are government reports coming out daily about labor markets, about inflation. There are geopolitical events, like I said, the price of oil, other commodities, and even decisions of other Federal Reserve banks around the world, not just ours, not just the U.S. Fed, but when Japan does something or when China does something with their currency or the interest rates, or what Europe will do with their interest rates, can really move our markets. And in the last decade or two, there's another layer, even on top of all this, and that is that our government leaders, especially at the Fed, they've learned new ways to influence rates and bond markets. Our government now buys and sells bonds like a 10,000-pound gorilla in the market. If they want to try to force prices up or down, they will buy or sell accordingly. And now it's not even just the Fed. Now you've got Fannie Mae and Freddie Mac choosing to buy bonds or sell bonds under instruction from the president. So the government has more control than ever, I think, on where rates could go. It's not just the Fed, and sometimes the actions of the Fed are actually fighting against the actions of Congress, trying to fight inflation. What does all this mean for you? Because it's pretty complex, and I want to ask the question and answer it. How can you track all of this, and how can you protect yourself? I would say this is especially important if you are in the thick of buying a house, and even more important if you're in the middle of building. I've had clients who are building a home and they don't have a rate lock, and rates go up. And it can be the most stressful thing in the world to be fixed on this expensive project and you have no idea what your interest rate or your payment is going to be in the future. So I want to talk about rate locks. When you lock an interest rate, the market movement will no longer affect you after that point. It makes it possible for the underwriters and all the people processing your loan to accurately know what your payment's going to be. We're not waiting till the very last day. And it also allows us to set closing expectations and give you a good experience because we remove the volatility and now we're starting to process your loan at a locked-in interest rate. It's most common to lock the rate when you are under contract. If you're buying a home, most contracts are for 30 days. You go sign a contract, we're going to close in 30 days, and we'll do a 30-day rate lock to set your payment and your rate and move forward with the loan process. Now, I know some loan officers who like to advise people from time to time not to lock at that moment. That instead we should float the rate. Let's watch the markets. Let's see if we can time this and get you a better interest rate, hoping that rates will go down and help you. Or sometimes they do it behind your back. They tell you it's locked, which is very unethical, and they don't lock it because they're hoping to get better terms and better income as a lender. So I don't believe in floating rates at this time. You and I are not day traders. We can't spend all day watching markets and trying to hit a bullseye when your rate should be locked. Rates go up fast. Like I said, the markets react to bad news quickly, and rates can go up very fast, very high. And they don't go down that way. They go down slowly over time. So there's a lot more risk than reward if your closing is just a few weeks away to sit there and not have a locked-in interest rate. I actually have a friend who they didn't work with me to buy their home 18 months ago. Their loan officer was recommended to them by their real estate agent, so they thought they would give them a try. And the loan officer told them they were locked. And then rates went up, and he came back to them and said, unfortunately, I forgot to lock your rate. And they ended up closing because they wanted the house. They had no other option. By the time they learned, it was too late to switch to a different lender, and it wouldn't have been possible because the market had changed. So they had to close with that rate and ended up with a payment that was about $600 a month higher than it should have been on their house. And they ended up paying that payment for 18 months. And just last month, we were able to help them refinance and finally get the payment that they were expecting, because fortunately rates have gone down over the last 18 months. So don't float your rate. If you are under contract, this is a time to be locked in. Now, here's where it really helps to work with a broker, because we can lock your rate with the best lender we can find for you today, and then we can get started on the loan process and things can move forward ahead of schedule. And it keeps things low stress for you. But if rates do go down before closing, I have other lenders that we can switch to. We can easily move your loan to a different lender. Of course, we need to have enough time to do that prior to closing, so it can't be the last week of the process. But this is the best of both worlds, because you get protection from the risk of rates going up fast, and you get the ability to take advantage of lower rates if they drop significantly in the first couple weeks of processing your loan. When I used to work for a mortgage bank, that was not an option. They have these really bad renegotiation policies. They'll tell you, hey, we got a float down policy, right? We can always float down your rate or renegotiate the rate right before closing. But the truth is, you can really only float down about halfway to the new rate. So if rates got a half point better, they might give you a quarter, and that's as far as you can get. Even all the lenders that I work with today have the same float down policies, but they're never going to get all the way to the new best rate that day. The only way to do that is to have a fresh rate lock with a new lender. So this is one of the reasons why I love working as a broker, one of the many reasons. Now, if you're building a home, I just want to point out that you can do a long-term lock. Many lenders will offer a 6 to 9 month rate lock. Now, the thing about those is that you're locking in a rate that's higher than today's rate when you do that, probably a quarter higher or worse, and you're only doing it for protection. Now, it also comes with upfront fees. You'll never be able to find a long-term rate lock like that without a deposit. You need to commit to that lender that you're going to actually close with them, or if you decide to ditch and go with a different lender, they keep the deposit that you made for that long-term rate lock. So they also have a float down provision. So in the end, it's time to close. You can check the rates, check the markets, and try to get a lower rate. But it's kind of similar. You're never going to get all the way to the best interest rates when you're using a float down option, right? So you may want to protect yourself. You probably should, especially it depends on the trend of the market. If interest rates are trending downward, then I don't have a lot of buyers who want to do a long-term rate lock and pay the upfront fee and lock in with one lender too soon. So what we usually do is we'll wait until we're about 60 to 90 days away from closing, and then we'll do a lock. Now we've got a fairly long-term, I'd say a mid-term rate lock with no upfront fees. We still preserve the option to switch lenders later. There's no deposits. There's nothing to lose. If rates get better, we go to the new lender. If they don't, we're glad we locked, and we close with the one we locked with first. So it's a really great option. Something we can talk about. Every situation is a little different, and it really depends on the timing in the market and the overall trend of rates. Now, what if you are actively shopping for a home? Is there anything you can do to protect yourself? A lot of the lenders that we work with have a lock and shop option. It's a little bit unusual. Most people don't lock until they find a home, write a contract, and then they lock the rate. But if you're in a situation where you're shopping for homes and you really do think rates are going to go up, you can use this option to lock in a rate while you shop for a home. Again, you're stuck with that lender unless you switch. These ones often do come with a deposit, but not all lenders require a deposit. So lately, it's not been the case because rates are trending downward in the current market, so we haven't been doing that. But if the market shifts and we end up in a rising rate trend, we'll start doing that with a lot of our clients to help them know what to expect and protect them. So that's a good option, the lock and shop. If you're actively shopping for homes, I have 2 pieces of advice for you. First one would be you can subscribe to my weekly rate update newsletter. It doesn't cost anything, but every Friday I send this out. It explains in simple English, layman's terms, what moved the market this week. It's got usually a couple paragraphs and a few charts to explain what is going on with geopolitics, with the Fed, or what is it that's making rates move. And it's also going to always show you national average interest rates for that week. Now, you just got to know our rates are going to be better than the national average interest rates that you see on that newsletter. And so the other thing I would recommend you do is once you get pre-approved with us, I will send you our app. And our app is going to show you your rate. And inside that app, you can run payments. You can change scenarios. You can say, well, what if I buy this house and this price with this down payment? And it'll show you everything about your monthly payment, including if there's mortgage insurance. It'll show you if you qualify. And we update those rates for you in the app on a regular basis, so you can always see. You're going to see the email that says what national average rates are, and then you're going to see in your app what your rate is and what your payments would be based on the homes that you're walking around looking at and thinking about making offers on. So it's a great planning tool, helps you get the right expectations. I don't know how people make offers on homes and they really don't know what they're committing to in terms of the monthly payment. So I think it's really helpful. Okay, so there you have it. A little bit of understanding of what makes rates go up and down. Admittedly, it's kind of impossible to just grasp it and know it. And I hope you can see there are so many factors, and your loan officer doesn't know what's coming next. We're not day traders. We're not market experts. So you can protect yourself by locking the rate, and you can preserve the option for a lower rate if you work with a broker. I love being able to switch a file midstream and get all the way down to the lowest rate if rates get better, not halfway through a float down provision. So I would love to be your guide in all of this. If you have more questions, if you want to see how the rates look for you today, give me a call. I would love to help you. It doesn't cost you anything to have a consultation with me, and we'll help you understand your best options and take a look at the market for you, and we'll have a deep conversation. I would love that. And as always, thanks again for listening and continuing your quest for home ownership. I'm glad you were here, and I hope we can do it again soon.
Thank you for listening to the Utah Homebuyers Quest podcast with Nelson Bars, your place for a strong dose of inspiration and knowledge so you can stay on top of your quest for home ownership. If you have a question or comment for the show, we'd love to hear from you. Visit homebuyersquest.com to record a voice memo or submit your question. You can also join our Facebook community to interact with experts and fellow travelers. Search Homebuyers Quest on Facebook to find the group and join the conversation. But with just a simple click to subscribe, we'll invite you back to the next episode. And remember, we believe in home ownership and we believe in you.